So welcome on stage, Astrid and Patrick. Astrid, you're active in the world of social enterprises, family offices, impact investing network, NGOs and corporates wanting to create a societal and planetary value. So really looking at probably every single type of and profiles of investors out there. You're the founder of We Are Impact Collective, an ecosystem putting impact at the center of the game. It's a collective of experts that guide all stakeholders in the ecosystem on their impact journey. You're also a limited partner, so you also invest in different impact VC funds, and you're leading also VP Capital, which is a family office contributing to and investing in impact. Patrick, you come more from the business side. You had a classical education with business degrees. You worked in various industries, from sports via gastronomy to real estate and events, and you told me through a backpacking trip, you started questioning a little bit the worldview, the so-called Western values. And you figured that these are not really corresponding to the real world, especially probably in the Deep South. And today, with the non-for-profit Knodel Foundation, you advocate systemic change, and through Innovation for Impact GmbH, you invest in business models that basically combine and reconcile economic return, but with an impact angle, being social or ecological. And you're also an investor in Wild Plastic, in the company of Christian that we've seen. So, you know, we've talked about steward ownership, we talked about other alternatives forms of corporate governance and corporate ownership. What has been your journey so far with this concept? Is that something that you follow actively? Is that something that you only invest in? What has been your exposure? So, who wants to start? Astrid.
Thank you for the question. I started 10 years ago in impact investing, really thinking of where should my money go in societal or planetary solutions. And since a year or two, I see the impact investing field growing. And I was thinking, are we now building the field or the systemic change that we really want? And in the wealth owners discussion I have, it's a lot about the VC language, like 8 out of 10 will fail, and the risk or the return should be rather high. And you start to listen and learn that actually the language that's now in this impact investing field, it's maybe in the end not what we really wanted to build, because we wanted to build something more in power balance and also creating a little more an equal society. So that's a little bit where I am. Since 2 years I follow this kind of companies, and I'm looking into organizations that are employee-owned or steward-owned or steward equity in different forms, as I do think it's the phase now for our impact investments to go.
And you, Patrick, what has been your, since the backpacking trip, what has been your exposure to these new forms of alternative ownership and governance models?
Yeah, there were many backpacking trips, but thanks for the invitation. Yeah, well, I got into this field in 2016-17. So 2016 was for me the tipping point where I decided that I don't want to earn money anymore with any normal job that extracts value from somewhere else, and I wanted to do something useful. And from that, the idea came to set up this charitable foundation, and from that charitable foundation, with many talks with other foundations, I got to talks to people in social business, impact investing, and so on. And I heard the phrase for the first time. So I visited 4 different economic universities in Germany and the UK, and I haven't heard one single lecture in my whole life about sustainability, about psychology, sociology, whatever. So I started from zero and just tried to find out, okay, is it possible to actually invest into businesses that put some value to the world and not extract it? And the way it's going now in the foundation, we have 22 funding partners, and in the for-profit investment, I have like 17 investments. Out of those, 3 to 4 are fund investments. The other ones are direct deals, and I have all sorts in there. So I have the classical VC model. I have invested into impact VC funds, and I have invested into 2 steward-owned companies, and also we can talk about that later. Other forms where maybe, I mean, there is something in between. I mean, when my father built his company, he wanted to build a company for him. He never wanted to sell it. I mean, that's how companies had been built all over time before the VC model, and that's totally forgotten. Like, it's not only you cannot own it or you have to sell it. There's also another option.
Okay, and among your portfolio of assets, being impact, non-impact, being steward-owned, or any other forms of alternative to corporate ownership, like, what do you see changes in the way, in your relationship to the founders, in the returns, in the impact that is being actually pursued? So do you see really like a lot of differences among these on the how versus the what we invest in?
Yeah, I mean, I see three main things that are actually, I mean, my portfolio is all impact. Only I have one tech that was in the first year. The rest is all impact. I mean, there are three main things, and some of them have been covered by Chris and by Maike. I mean, the first one is that many useful things to do that they cannot be scaled in a way that a VC wants them to scale. I mean, while plastic is one example, but while plastic is still something that you can scale to a certain extent, where you can have a certain multiple as an investor, but there are many things. I mean, many companies also here running around, they're not even sure the problem they want to solve. Is it for profit? Is it non-profit? If it's for profit, how much profit can I get out of that? So I think many solutions, especially also hardware and social solutions, are just not valid for a VC model, which means they don't get funding if everybody just raises 200, 400, 1 billion VC funds. So they always talk about the big numbers, but they forget all the people they never give money. So that's one huge thing that I've seen. The second one I would point out is that the VC logic itself is very extractive. Mm-hmm. It comes from the world of business that we use to bring the planet to where we are. There's a quote from Albert Einstein. He said, "We cannot solve the problems using the thinking that we used to create them." Maybe it's not completely correct, but more or less. And I think that's very true. And many people in the VC industry, they come from a financial background. They are trained to use those tools, and they just apply them on impact now, and it doesn't really fit. And even if it fits, even if you scale the company, I mean, that's what Maike was talking about. Think what happens then. In the end, we live in a world where we have extreme inequality. We have an eradication of democracies because global corporate constructions can basically go to whichever state they want and move their supply chains around whatever they want. And if a democratic state passes a law, they say, okay, we go somewhere else. So that's the world we live in. So this is something we have to change. And if we only fund everything with the VC model, then after the VC, there comes the private equity investor, and after the private equity investor, there comes the billionaire or Google or some corporation or Nestle or whatever. Do we really think that by selling all impact companies to the people who create the problems, we solve the problem? I think that's just incredibly naive. And thank you.
that deserves a round of applause. Yeah, thank you.
And the third point I want to make is, Chris referred to it, this imbalance of power that we have on a global level, we have it also between funders and people who receive the money. I mean, I run a charitable foundation as well. It's an even bigger issue. I mean, if the white dude from Germany gives money to a small NGO from Mali, to get to a level of understanding with each other, that you work together and that there's not this huge disbalance of power, takes a lot of work and effort from both sides. So if I, for example, take Wild Plastic as an example here, Wild Plastic was the first investment in 2019. It was the second steward-owned investment, but it was the first investment that was handled in a way that, okay, we got to a point where we saw, okay, there are 4 investors who want to do this together, who are able to bring in the money that they need at that time. And so from day one, we said, okay, we are only doing calls together. So there was not one call just with me and Chris. It was only the 4 investors together with the founding team. And we discussed from the beginning what is useful, what do you need, how do we structure this, what kind of returns can we actually ask. So what do I need, what do we need in our structure as a minimum, what can you give based on your business plan as a maximum. So you cannot do what I call the Berlin-San Francisco stupidity, where you just put a graph that goes up to some endless point
the hockey stick
on the horizon. You cannot do that because Chris knows he has to pay me back what I invested and the multiple from his own business. So he has to be very, very clear, and he has to rethink a lot what he's actually planning. And that creates an understanding of investors and founders being on the same side of the table. It creates a common sense, and I think the whole thing about impact founders are being so under pressure. They have to work against the system. All the incentives are against them, and that puts huge pressure on them. And I mean, they're all close to burnout. And then if you then also on top have investors who just push you all the time to create a multiple of 5x each year, I mean, that can't work. And this is really, really different in that setup.
And Astrid, do you see also this collaborative approach between founders and investors among your portfolio and among your assets?
Yes, I do see a real difference when it's a general VC kind of type. When it's more in steward-owned or employee-owned or collective or cooperative or whatever, you see that the balance, like you said, Patrick, the balance of power is different. Because the decision power is much more in the company and not in the investor's role. So that's really changing. I also think that the discussion or the reflection that the investor has, like what is enough, that it's something coming now into the reflection. And we used to have that kind of discussions in the philanthropic world, like I have too much of my wealth and how much do I want to give away. And now I see that the same thing is happening in the investment world. And it's kind of nice because then you can give back the power to the people who just have the entrepreneurial idea, they want to build a company, and the company will also be alive for a longer period, because for those companies and funds, it's going from Series A to B to C, and there's always pressure on timing and getting money and funding, and it's taking stress out of the company as well, but also putting money in the company to make it more long-lasting and more innovative. So I do think that the reflections of people working on this field of this new kind of funds or companies is really having a different narrative than the traditional VC, and that values are much more in the discussion than it used to be.
Yeah, I mean, we all argue that venture capital is a people business, but we usually forget about the people within the business. I mean, impact founders have actually like two edges, right? Two type of pressure. First, they need to build a financial viable business model, and on top, they need to have an impact. So it's a double-edged pressure for them. And this concept of enoughness, what is enough actually for an investor to be living adequately, to be happy with an investment that he's making? You've been doing, these types of investments in alternative forms of corporate ownership and governance models for quite some time. How have you convinced other investors to come along? Because it's not just, we need scale. We need, referring to Wild Plastic, who did a recent funding announcement. How do you actually convince co-investors to come along on your journey? What do you need?
The best way, I think, is to have the reflection and the thought-provocative kind of conversation. It's not happening so like in a quick call or something. You need to have some time and to rethink really on their own beliefs. And the other thing is all the proof points. As you showed in the beginning, there are many big companies, small and big companies, that already showed that in the end it's maybe less of a risky business when you're in a steward-owned company. So proof points. And thirdly, I think putting the narrative and making sure that more people know about it, because even I have been in the impact investing field for a long time, and it was not since the beginning on my mind. I didn't think of it. I just thought about the what, the planetary or societal solution, and now it's much more about, okay, how? and when. And so, yeah, I think these are the three things that pop up in my mind.
I don't know how I convince. I don't know if I have ever anyone convinced. But for example, Purpose Foundation did an event in Berlin in October, and there were also many people, and also people I talked to. For example, you were referring to the people who exited their companies and now become investors themselves. And many of them are actually critical of the system that made them rich, because they experienced themselves what crazy pressure it was to have a tech VC on board that wants to see X within time Y. And they are actually saying, okay, if I want to invest my money now with purpose and with impact, but I also want to do it in a different way, and I don't want to put people's lives at risk in the way that it has been done to me. So I think that's one group that's actually quite addressable. The other thing is, you mentioned narratives and the 8 out of 10 failing. I mean, that's when I started to go into that area without having any experience. I mean, I didn't even know what a convertible loan agreement is. It was just learning by doing. And like everyone I talked to was like, what is this? Like, you want to do venture investing? Are you crazy? 8 out of 10 fail, and maybe one survives. And if you're really lucky, then you have that one unicorn. And then if you walk around and say, where does this narrative come from? I mean, that's the narrative that the VCs are producing themselves. I mean, they are always looking for the unicorn. And when you're always looking for the unicorn, you oversee all those sustainable, passion-driven companies. And then you say, okay, I didn't find the unicorn, so that's why the VC funds in general, I think almost none of them is actually delivering the return that they are promising at the beginning. So what is the narrative? What is the narrative for what is a decent return? And we just have to be much more realistic there. And if I look at my own portfolio, I think I had 4 failures. Out of those, 2 were impact companies. And out of those 2, 1 was just bad management. If you put your money on the wrong founder, then you're never going to be safe for whatever model there is. And the other one was just pushed out of business by a corporate where you just had no chance. That's just one of the classical things where incentives go against you, and if there is a big money game, and they just crush you. So if I look at all my existing portfolio over the years with Corona and with now the backlash in financing, I think most of them have been on the edge of going bankrupt, but they refuse to let go. And this is something, this purpose-driven founder thing, I really want to do this. This passion. I'm not a serial entrepreneur. I don't run around getting money from one fund, try something, get a team, it goes down. I run around, call myself a serial entrepreneur, and start the same thing over with somebody else's money. That's not what happens. And I think this mission drift is in impact entrepreneurs in general, but it's being supported by that model, by steward ownership. And I think if you take some time to talk to people, to reflect on those things, and if you question the narrative that they all come out of their business school and out of their whatever, EY, McKinsey, Boston Consulting Group, wherever they were, if you manage to question those things, you find the right person, then you can empower them, but I still believe it's still a very narrow portion of people who are actually going into this and are willing to go deep into that and question their own beliefs.
Yeah, but is there not also like a system change in the narratives on the KPI, how we measure returns, impact? You know, like we talk about impact management and measurement, we try to have some metrics that helps us define what is success, but are we not trying to measure the kind of this new type of ownership and governance model with old tools?
Yeah, I do think we are trying to do it with the old things, and maybe the impact frameworks are not that old yet, but we try to apply the old impact frameworks on the new kind of thinking. But I would like to have some new KPIs. I think we talked about it before. It's like today we count the amount of exits So many exits have been successful. And I hope we can come to a new kind of KPI with the amount of companies that keep on existing and maybe not become really the biggest of the world, but that there are many more, that it's a distributive model and distributive economy with a distributive power. And I do think that there are new KPIs coming up, just like how long can companies in the end exist, much better KPI than the numbers of exits.
So
yes.
From a VC perspective, that would be actually capping the downside scenario and making sure that the companies still subsist and survive versus having one unicorn that returned the fund, this kind of outlier framework.
Yeah, I think so.
I mean, if you mention the unicorn, how do you get a unicorn? A unicorn, if a company, let's say Google, with what they originally did, like a search engine, why are they worth so much money? Because no search engine other than Google can exist next to Google, and by definition, something that gets so big and so powerful, it cannot have a positive impact for most people. It will always be extractive, and this framing cannot be the right one. So I'm a bit, I tend to start laughing or smiling when impact VCs tell me that they are looking for an impact unicorn. That it doesn't exist.
It's counterintuitive.
I'm sorry, but
it's
that's, can I say this on stage? That's just bullshit.
Yeah.
And
excuse your French.
Yeah, I'm sorry. No, I'll leave it there.
Okay. Last question before we wrap up. What would be an ideal fund for you to invest in? Because we talked about this new asset class, that it could actually exist between philanthropy and VC, or is that supposed to replace one or the other? Can we talk about a blended type of asset class that combines a little bit of the benefits of philanthropy and venture capital?
Well, I think the real ideal fund, but that's really ideal, it's of course blended. It has philanthropy and normal investment money. It's maybe a little bit more organized, like a bank instead of the VC model. And it's trust-based, so it would be money given to an entrepreneur, and he or she could use it in the way that he or she thinks it's really needed. So no power play of the investor, but really trust in the company and trying to make the company as successful as possible in a healthy kind of limit. I think that would be the ideal, and I would like to do it with many nice people together. So the portfolio companies, but also the investors, and really try also to protect the logic in there from everything else outside that's already built. Really try to keep strong on building what's needed on a systemic view.
And value alignment among all the moving parts.
Value alignment.
Yeah, all true. Maybe I want to add again what I said in the first answer. Like there are different forms of ownership structures. There is not only VC versus steward ownership. There is many things in between. And also, I mean, why is there a necessity for a VC and for a venture capital? Because the bank doesn't do what the bank was supposed to do, finance young companies that develop a business model. That's exactly what banks don't do. So we have to pull back banks into this game. That's a huge game changer. And then also existing investors, I mean, just ask the people you want to invest in what is their goal. Maybe they don't want to go for steward ownership because they say, hey, I'm working 60 hours, I'm taking so much effort, I want to have something from it. But they also don't want to become a billionaire. Maybe there's something in between. Maybe you have like 2, 3, 4 strategic investors who own large shares of the company. Then you have some employees who own shares of the company, and you have a foundation that some profits go to, and you have a mixed model. You have cooperatives. I mean, I'm from Germany. There it's called Genossenschaft. Much of the old school economy was based on things like that. Much of the banks were based on models like that. So it's not that we have to invent everything from new. Many things are just there, and just the public framing around VC, tech, growth, and eternity just erased them from our minds, and we just have to go back to that and just use the tools that are already there.
and leveraging the narratives and the stories so that it emulates, and because I think what is also missing is this information sharing or knowledge sharing. So I'm glad that we were here today at ChangeNOW to discuss this topic. If you will encounter any co-investors around the conference today, what would be your kind of key call to action?
First of all, do it, and don't always wait for the others to approve you that you can do it, which is also what VC funds often do. They need 5 others who tell them we also do it until they make a decision.
This FOMO type of approach?
Like if you're an investor in early stage ventures with impact,
followers,
take a decision and do it and get going and work with the team instead of waiting for others to tell you what to do.
Yeah, I think I would question the investments that you're doing. Are they really building this new kind of world we need, where there's another kind of power and a more balanced wealth behind for all of us, and not just for a happy few, so that you really look at a different way, in a more systemic way, to the investments that you do.
Not only looking at the what you invest in, but the how. So thanks a lot for all your key insights. I'm hoping that the audience got a lot of key learnings and that they will start kind of pioneering or questioning the current model, the current language that we're using, so that we can get into more adventurous territory around corporate ownership and governance alternatives. So Astrid and Patrick, thank you very much for being here on stage today.
Thank you.
Thank you, Sabine.
Thank you very much. So we're finishing this up, and I just want to give you a few key messages from these 2 panels that we heard. First, dare to be pioneering. I think we need to be creative, we need to think outside of the box and kind of question the usual language that we're using when we are investing. I would come back to what Astrid says. It's about an exist strategy and not an exit strategy. I think trust is paradigm. It needs to be among the stakeholders, and we need to rebalance the power in the relationship between founders and investors. And at the end of the day, what we're trying to do here is basically what nature has already done, right? It's about regeneration of capital, so that it can recycle and not be consolidated in the minority. So thanks a lot for being with us, and I hope we got you inspired, and you can then go on your next journey and be creative about corporate ownership and governance model. Thank you very much.